Why, hello, everyone. How's it going? It's Wednesday. It's the last day of May. It's the 31st. It's 2023. How's everyone doing tonight? Let's do a podcast. So, we will be looking at a lot of interesting things on the screen, a whole slew of data, but I'm going to try to record this where I don't touch the screen all that much and I talk as if it is a podcast and you're not looking at the screen. Meaning we can just listen and talk about what's going on and the screen will be helpful, but this is a podcast. So let's do it. I've I've been really working with a stock market, stock options algorithm recently, which is a way of organizing all the companies on the market and looking at their stock option prices and becoming active at like day trading, playing off volatility. There's a lot of interesting things that you can do with this. And it is the best money-making algorithm that I have ever created out of all of them. That includes all the sports algorithms I've ever done. This is so, I want to say reliable, but that's not even the right word. This is so helpful when it comes to purchasing stock options and understanding what's going on with companies every given day, that it's very, very difficult to not make money using this. And I'm going to go through some companies. I'm going to go through some examples because I am learning just like you are. We're learning from the algorithm as the algorithm tries to tell us what we are supposed to do to take advantage of fluctuations in the market and offer yourself a weird type of profits. I feel like what we're doing is we're taking slivers off of the peaks and troughs of volatility of stocks, meaning we purchase a call and a put option, which means we are purchasing the right to a contract of 100 shares at a certain strike price. It's complicated, but let's just assume that we're buying this contract and we are predicting that both the company will go up and down. We are buying a call and a put. And what that does is it makes us make money when the company moves more in terms of like change in their price, moves more than the cost of the call and the put together in terms of what the contract is worth. And the reason why I seem to have so much difficulty explaining this abstractly what we're doing is because it is kind of abstract. There's this contract that you're buying. It's an options contract. And the contract has value. It actually has 100 times the normal value of per share, sort of, because you're buying the right to buy or sell certain shares of a certain stock at a certain price. And I know it's abstract to think of, but just understand that what we're doing is we're finding companies that are moving a lot and more than the options sellers are pricing into their contracts. So we're basically rolling the dice on a company that we think is going to move around just more than the public thinks they're going to move around in like the next week or two. And because of the way you buy the contract at the same strike price, depending on how much you pay for it, you have some risk, but you also have a lot of potential upside if the company moves more than normal. So that long-winded explanation of what we're doing with the straddle stock option algorithm, or the Straddler, as I call it, is finding the companies. I'm focused on Apple here. Look at Apple, only down 5 cents today. Now, this is deceiving because I watched Apple all day today, and I own now only one option of Apple. I had two. I had a call and a put. I was able to sell my call option today for a profit. I bought a call and a put at the strike price of 175 on Apple back on, did I do it on Tuesday? I think I did it. I talked about it in a video. I think I might have done it on Tuesday if I didn't do it Friday. I'm pretty sure I did it on Tuesday. So as that was only 4 days that this option had a life of, which means it expires on Friday. Well, they went up about 1% at one point today. And I was able to sell the call option that I had on this company for $425, I think. 430 maybe, 425, I think is what I got for it. So because I bought the two of these for 380 and I sold one for 425, I made $40 already on this 380 invested. It's probably like 12% or something like that. Now so that's guaranteeing profit, meaning they moved enough over the last few days upward that I was able to sell the call and profit on it entirely. I still have a put option on them, meaning meaning if they go down over the next few days before Friday and they start to go below 175, that put option will be worth money too. And that is pure profit because I just sold one option for the price of both of them to begin with just today. So what the strategy is all about is finding these companies that have relatively inexpensive options. The reason why that worked, the reason why I was able to make money is because as we were ranking companies, we looked in the stock options area and it talked about how much this option cost. And this is a new option that expires on the 9th. This isn't the option I actually bought, but the prices that came out ended up being under $400. It said Apple will move probably $3 or $4 at least over a week, and it's worth a shot based on the ranking system that we have for this. So that worked out, and I made money today on Apple. And here's what's really interesting. At the end of the day, something happened. Now, I don't know if it was the end of the month or some other news that I have not been aware of. Maybe I need to log into some website to figure out what the news is. I don't know what happened, but at the tail end, the last 10 minutes even of the market today, there was weird selling. A lot of stuff went down. A lot of stuff lost its gains for the day. So you can see that today there were 43% advancers, 57% decliners. Apple was up 0.5% to 1% the whole day, and I guess they ended up down. Good thing I sold them when it was profitable for me to do so, which is a great thing about the straddle strategy. Is here's how it works. You buy the call and the put on the company. You then root for it to go in either direction, but to go there fast and to go there with a lot of velocity and a lot of inertia. So it's all about moving to a price that's away from the strike price as fast as possible. As soon as it gets there and slows down, you're going to be profitable by selling one of those. You just sell it. If it's early on in the option period, you have like 3 or 4 days left, you just sell it. Even if it's only 5 or 10% profit, whatever it is, you sell it because you want to guarantee yourself a profit. And then you can reinvest that money that you just sold and now turn into cash. And you also have the other side of the option, which you can sit back and watch for the period of time until it expires to see if it gets valuable. Let's talk about what happened today with semiconductors, because this is an excellent example of what happened today. So we're looking at semiconductors. If you've been following this video series at all about the stock option straddler, the podcast, you may remember that we had the company Marvel. That I talked a lot about semiconductor companies last week. Marvel was a #1 pick on Friday. It was so nuts on Friday, going up 30%, that I bought a call and put on them on Friday and sold the call right before close to profit on the entire transaction right there. I bought $399 worth of options and I sold the call for $420 at the buzzer on Friday. And I had a put. Well, guess what happened with the put? Oh, did Marvel start tanking this week and everyone take a bunch of profits because it's the end of the month? Yeah, they did. Yup. They dropped by $4 today. And you know what else? AMD, other ones, they all dropped. I had an AMD as well. I had a Taiwan Semiconductor, which has not made money yet. That's one we still have to watch. But AMD dropped by $7. I had this hilarious 120 or 121 put or something that was worthless on Friday that all of a sudden I sold for like $200 and something today. Awesome. I sold my Marvel for $300 today. Thing was worth like $42 on Friday. Sold it for $300 today. Probably should have held it. They're probably going to go down even more. But I was just like, I'll take it. Because all of a sudden now on Marvel, I made $320 on my $399 investment. I made like 70%. Not just 5% like it looked like when I sold the call originally on Friday. That's the beauty of the Straddler strategy. is that you're guaranteeing profit as fast as you can. You're guaranteeing profit. So you're essentially free rolling with any change in market direction where your alternate option all of a sudden gains value. That happened for Marvel. It happened for AMD. And Taiwan Semiconductor went down, but not enough yet. I need this to go down to like 97, I think, to make money, because this was 500 bucks I spent on this. I spent more on Taiwan Semiconductor than I did for no, sorry, I spent 640 on AMD. I spent more on AMD, but AMD all over the place continues to be a great company for straddling. All right. So let's go back and take a look at the day for a second here. So we have something going on, like any crazy news that causes drastic movement in the market is fantastic for the straddler strategy. The worst thing that can happen to you is if you are buying stuff that nobody's trading and doesn't move at all day and doesn't move for a week. That's terrible for you. So you want to go with companies that are active, which is why I realized it's important to look at this list in order of movement related to option price. So I updated a bunch of options. And once again, the biggest gainer of the day on our list is Twilio or whatever. Twilio? I always say Twilio, but I guess it's Twilio. They keep doing this. They have been a recurrent theme on this list at least 3 or 4 times I've seen them over the past few weeks. They do it again today, moving $6. Good for them. Their options, while they're expensive for a company that's in the 60-something dollar range, 60 whatever, there's all this weird news about them like changing around their structure and siphoning off stuff. And I don't know what is going on, but whatever this weird news is, it's causing this company to move. So it shows up as number 1 on the list, and I guess the algorithm is recommending it even at 500 bucks. I'm going to double check their option price real quick, because I just want to know if it's changed at all, because I watched it today and I've never bought it, and it keeps showing up and I just never ever buy it. And I probably should, because number 1 picks you're supposed to pick that the algorithm is putting out. And this one has a pretty good rating, and it's moved more than enough today. So it's June 9th it's actually more. It's like 530 bucks now is what this actually costs. So it says yes, even though it's kind of expensive for its share price, but it's just doing good things. So that's the one that it recommends. I'm not gonna. I shouldn't really have to personally give a guarantee on anything. I'm doing the video, but I'm discussing my own opinions. But I'm also just reading the algorithm. And whenever the algorithm kicks up a number 1 pick, these almost always move enough. Even Foot Locker was on here once. They moved enough on the downside. Like, it's very difficult for one of these up here to not pull it off over the next week if you're looking toward June 9th. What else do we have here? I don't know about this Monday company. Roblox, shocker. They're low share price though. Not T-Mobile. I bought T-Mobile today. I had forgotten to buy them. Or I probably like already profited on them or something last week. So I bought them again for the new option period going through the 9th. They just always move around. Even contrary to market, whatever, they're just weird. They move more than normal, and that's why they keep showing up here. So they're good. I also bought Pepsi today. It's another thing I bought. I saw it on this list, and I saw this high share price of 182, and I said, really? I can get options for 350 bucks for a company that could, like here they move 225. That's 63% of the way. That's the thing, is when you use this strategy, even if they don't move all the way, there's some premium built into your option that you own. And sometimes they only need to move 90% of the way, and you could still sell a profitable option and still hold the other one. Speaking of following profits, let's talk about some stuff that's expiring this week. It's got a lot of stuff still expiring Friday. I had a really good day. I had a bad day on Monday and a really good day today. More than covered for the losses on Monday. It was like down 500 and then up like I was up between 500 and 800 today all day. And I'm interested to see what happened that dropped a bunch of stocks, because something happened right at the close. I do not know what it is. And I don't know if it's going to impact tomorrow, but something weird happened. It could have just been the closeout for May and everybody just banking their profits at the last minute of May. but we'll find out, of course, Thursday morning. This stuff, I mean, how great is this to play the market in a fashion where you don't care if it's up or down as long as it's just overreaction in every direction. That's what the funny part of this is anytime there's news, if it's good or bad, you win, right? Because the news is going to drive the stock price abnormally in a certain direction. So now let's talk about profit, and we're going to talk about how you work with this strategy in the mature period of the stock option. Meaning, I'm testing this out on weeklies. Okay, weeklies meaning I'm owning these options sometimes less than 5 days, but generally I try to make it like 7, 8, or 9 days. Like I'm buying stuff for June 9th now. Here we are going into June 1st. It's like a 9-day option, even though there's only 6 or 7 trading days in there. Point is, I'm doing this on a really, really narrow, small time scale because I wanted to see if the algorithm's so good that it wins on even that narrow time scale. And the answer has been yes, it does. So the point is we are coming to Thursday and only 2 days left in the option period, where a lot of options I talked about last week, some of which I still own, some of which I don't own. Like I already got rid of AMD and Marvel and made like 50% profit on both of them, right? Which is crazy. I made like $600 or something on those two. Almost, yeah, it was crazy. And I still have Taiwan Semiconductor, which I might lose on. So we have to see how that goes. I need them to go down again tomorrow or on Friday or something. So let me talk about how it gets complicated toward the end of the option period. And we'll do it with Starbucks, because Starbucks was the #1 pick of Wednesday of last week. It has been 1 week, and currently they're at $97.37. The option that I bought and the option that was discussed right around the time period when Starbucks was the pick of the day on Wednesday of last week. So I guess that would have been the 24th, I believe. We look back at that video. I think that's the video. It's got the picture of a Starbucks AI image on the thumbnail of the video. Point is I said that's #1. #1s need to win, right? #1s are on here for a reason. I say they win. So what's going on with them? Well, of course, I watched them today all day because I have one and I want it to be profitable, but I don't want to cheat. And so I just kept looking at it and I was like, all right, are we profitable yet? Are we profitable yet? It was so close. It was so close to the point where the bid ask price on this was, I paid $299 for my Starbucks option. So we got to clear $300. There was a point today where you could have sold the put for just about 300 and basically broken even while having the other call option still alive, but it never really got there and it never sustained it. So it's still not there. So they need to go down again tomorrow on Thursday. And this is where we get into a discussion of what we're going to do here. Now, it would be great if they go down on the open and we can sell this thing for a profit a little bit after the open, hopefully for more than $300. That's the best case scenario. Can't predict the future. That'd be great if that happens. Well, what if that doesn't happen? What if some reason there's good news and the market goes up on Thursday and Starbucks picks up that tailwind and goes up with it? That means they're going to move from 97 and probably go up to 98 something. If they go up to 98 something, then the value of the put that you have, the one that's almost worth $300 right now, because they're almost at 97, and the put I have was a strike price at 100. Strike price 100 is what I have. So right now there's $263 in intrinsic option value that exists in that option. We won't get too technical, but basically it's worth premium, some undetermined amount of premium plus $263. So that means that I should be able to sell it for $263 or more, probably more right now. But for some reason, it's not over 300 or 305, let's say. It's not there. So what do you do? What do you do? Well, it is my experience that when you think about the movement in terms of days, oftentimes weird stuff happens at the open of the market and stuff moves distortedly in the morning at the first half hour, first 15 minutes even, more distorted than mostly the rest of the day. So you wake up and if they go way up, you start to be faced with a question, which is, where is your cutoff where you need to minimize your losses on this option because it expires on Friday. So if they go up tomorrow and then go up again on Friday, but not very much, your options are in bad shape. And the 260 something dollars it's worth right now could drop down to 100 or less, depending on where they go. So here's the way I've thought about it in terms of percentages and what makes a lot of sense, which is you do not want to find yourself waiting on a Friday, with both options on a Friday, not knowing what to do and losing a high percentage of what you invested. So Thursday is the day that you actually need to make move on options that have not matured into profitable zone at all through their life yet. That means that, for some reason, Starbucks hasn't made it there yet. So we're going to have to cut our losses or something, or at least change the nature of what we are watching for the rest of the week. We have to do that by selling one and taking some back. It's the 75% rule is what it is. If you can get 75% of your overall cost in the sale of one of them on Thursday, you take it. You take it because losing 25%, while not great, by the way, you haven't fully lost 25% yet either, because you still have a call option that has some value. If I decide to wake up in the morning and I sense they're going up, and I'm worried they might continue to go up because there's some whatever reason, it feels like they might be going up and they start going up, I'm going to unload this at 250, 240, 230, even all the way down to $225-ish because I spent 300. That's 75%. I think that's right. Yeah, that's 75% is 225. So I'm willing to let go for 225 and lose $75 minus or plus whatever I end up selling the call for when that happens. Because maybe they go up a ton. Maybe they go up a bunch and the call actually is worth something. And then you actually do make money if you sell the call for more than $75. But let's cross our fingers. Let's hope that when you wake up tomorrow, you see Starbucks go down on the open and you can sell this for a profit and not even worry about it. But you take any profit you can on a Thursday. If they offer you $305 for this, you take it in the morning. That's fine. That's fine. It's Thursday already. You don't have days and days. You have one day after today. So you take a profit. And by the end of the day, if you're at 75% on any one of the options that you have against your cost, you take that too. So that's the rule that I'm comfortable with right now, that I'm operating with, because I've made the mistake of not doing that and it doesn't work out. And you really want to not go into Friday with anything that you need to have make money. Fridays should only be options where you have like a remainder option that's left over from the pair that you bought and it wasn't worth very much and it's all gravy and it's all profit anyway because you already profited on the other side of that transaction, when you sold the different one. So that's what you want to do on Fridays. You don't want to have anything that you need to move in a certain direction on Friday to profit. That's bad news. So we will see what happens with Starbucks tomorrow. I can guarantee that I will sell the put of Starbucks tomorrow. Absolutely. Because there's no way, it's already over 75% right now. And therefore, I am going to be selling it as it drops if they start going up in the morning, or I'm going to sell it for a profit if Starbucks starts dropping in price, because share price goes down, I'm going to be making profit on that. So that's how we played the number one pick from Wednesday of last week. It's a really long discussion about that, but it's important because what you own is you own this contract that has this crazy fluctuating value. You need to understand that at a certain point, your time that you purchase starts to run out. And if you don't act before your back's against the wall with the timing of the expiration of the option, you can find yourself losing a much higher percentage of what you invested. So, all right. That's the discussion about what we'll do with Starbucks tomorrow. Like I said, hope they drop on the open. Let's talk about what else I bought today. So I did buy a little bit of Advance Auto Parts. I bought just a call though. And this made me want to go into a whole different discussion about like what else you can do with this file and analyzing companies. So Advanced Auto Parts, bad earnings, bad guidance or something. I looked at their financials after this. This is a huge overreaction. Like they're still a profitable company. People are still fixing up used cars and keeping them on the road. Like there was a lot of bullish talk about the car, rental car, fixing car, keeping cars running, market, AutoZone, Advance, all those guys. There was a ton of bullish talk about that just recently. They're still profitable. There's nothing in their financials that made me worry about this company at all. Like your Advanced Auto Parts is still going to be where they were, changing your battery when you need it, which I think I need to do on my car. Anyway, point is, I saw this. I decided not to buy the put. I saw them dropping this insane amount, $38 today. I mean, what? Look at the old option we have on them is at a strike price of 112. That's what happened before today on Wednesday. Craziness, right? Well, I caught this later in the day, and they were hanging out right around here at this $73, $74 range. And I bought just a call for June 9th for like 179 bucks or something, because they are probably going to recover from this nonsense. So the algorithm is picking off where there's just this is just nuts. Like a company that is a brick and mortar company that sells, auto parts for cars that are still on the road. I don't care how bad their guidance was. Like, I don't believe it. Like this is ridiculous. Nobody should be dropping this much in value. 30 something percent, 35%, I think is what it was. So they are going to rebound from that. I was like, I'm just going to pick up a call, and just because that's fine. Like I'm okay with that. So algorithm, see how much bigger this is, this boom number is? It's insane. Like U-Haul also took a beating today, but they're a lower share company already at 60. And just you can see how there's just more room for Advance to go back. So I think the call is the only one I needed. We'll see if they continue to go down. I will lose my call if that happens, but I'm going with the algorithm on this. This nonsense means that the company is going back in the other direction the next day. Like, unless there's a real fundamental reason why this is happening and a company is dropping by 30% in value. Imagine a shark took a 30% bite out of your body, right? You'd be a completely different company. Do you think Advanced Auto Parts is a different company from yesterday? I don't think so. And the numbers, are telling us that. All right, next. I bought something else today. I bought a biggie. Let's see where it is. I bought Home Depot. So Home Depot, where'd you go, Home Depot? I don't know how to spell depot. Really? Where is it? Why isn't it here? You serious? Yeah, there it is. Okay. So I bought Home Depot today, and I overpaid because I screwed up when I bought it. I spent $980 on Home Depot options, more than I wanted to. I screwed up. I didn't purchase them at exactly the same time. I screwed up. But I'm okay with kind of screwing up for now. Let me explain why. So Home Depot, for this option period, they are right now at about 283 or something, 283 something. They also went down weird at the buzzer. So they keep popping up on here as moving very close or more than their option amount. I've caught them doing this more than a few times. And I see this big, $285 share price. They moved $7 today. They'll move around kind of quick. They just have a good chance of moving more than this, and also moving somewhat. So even if you get kind of trapped next week on a Thursday or something like this, and they haven't moved enough away from 285, which is the strike price I have on them, that I need them to migrate. I need them to go to 275 or 295. But that's a lot of time for them. As you see, like a $6 move, it's not that big. It's like 2% for them. And so there's also summertime. There's weird brick and mortar stuff going on, and they have this high share price. Because what I'm trying to use the algorithm for is not just find us companies that are profitable, but find us companies that are nominally high movers so that we have more choices during the day. Because otherwise, when you're working with smaller share price companies, you're unable to trade them as frequently because the change they're making is much, much smaller. So like something like a company like Home Depot here, while this is 3 times as expensive as Starbucks, they're 3 times as much in share price. And so you're just going to see different movement out of them, which brings me to another point I want to make, which is we need to use the algorithm here to identify where there's supposed to be news and potential movement on companies. And so that we're not as reactive to their movement from a certain day and more proactive to what their movement is going to be. So my thought on Home Depot is summertime Home Depot just involves a lot of people getting out doing more stuff. They're active enough as they need to be anyway. So I feel like even if they have a week where they go up, they go down, they go up, they go down, they don't do what we want to do, you're still able to salvage 500-600 of this because they move so much on any given day. You know, this $6 a day is normal for them and actually a little low, I feel like. So they will move around and we'll just see what happens with that. But that is the biggest one that I can remember buying so far was that one. And it's just, they have a really good spread range. You know what the value of this thing is. There's a lot of reasons to do it. The only reason not to do it is that it's expensive. But when a company keeps moving like this, then you got to try it sometimes. Look at AutoZone getting pummeled. Didn't move as much as they needed to. You spent $9,400 on their options. They only moved $8,100 intrinsic option value today. So it didn't fully get there. That's why this is a total gamble. This is way too expensive. You imagine spending $10 on a week long or 10 grand on a week long option. I mean, you're really rolling the dice there. That's a lot of money. Yeah. And you need a big movement. You need $94, $95 movement, right? All right, what else did I want to talk about here today? I mean, I think that what you can end up doing is, as I said, we're going to track movement and volatility and find deals. You know, that's why there's, you know, these green numbers that show up here. Low rating numbers is good. Anything close to 0 is good. Like AstraZeneca is probably pretty good for some reason. Cheap is the reason. What else do I want to talk about? There's a lot to still watch, but as you can tell, every day when I would do a video about this, I would be like, well, the algorithm says buy Twilio. I probably should buy that tomorrow. I keep saying that, and I never do, but I guess I should for next week's option period. At this point, I have to just do it because it'd be like buy Twilio, and it would be like buy Advanced Auto Parts. Even though Advanced Auto Parts are much more expensive. That's the problem. So this may be out of your budget. I didn't want to spend $1,000 on this. I figured, like I said, I spent 200 on less than 200 just to go one way because I was like, I can't piggyback on. There's no reason to. I had to did some research about this company to figure out if they're really in dire straits, and they're not. So anyway, that's the podcast, guys. Like there's so much going on here. I have to say I'm really happy with what this is doing. It's just presenting mathematical reality about movement of companies, and using it is what an advanced AI would give you when you would ask it questions, say, which company should I straddle with stock options? I mean, this is what the AI would do, is it would grab current information and it would run it through the ringer and figure out where the best deals are for the most movement, and their Twilio, you know, and that's the day on Wednesday. So we'll be back on June 1st and we'll see how everything goes. We'll see if we will be watching Starbucks on bated breath. You know that I've walked past Starbucks recently and refused to go in and buy a coffee there because I'm rooting for them to go down right now this week. I'm not giving them an extra $3. That's right. I think a coffee is $3. I don't like their coffee that much anyway. Point is, rooting for them to go down. If they don't go down, we got a tough decision and we got to cut our losses on them. And a number one pick will go down. There's also Verizon. Verizon was the number one pick from one of the days as well. And it almost got profitable today. They went up and they need to go up tomorrow. So Starbucks needs to go down. Verizon needs to go up. A whole bunch of other things need to happen. We'll be back on Thursday and I'll let you know how it goes. So good luck. If you want to empower yourself to take a gander at the market, go, take your stock options class, get your authorization from your brokerage to trade stock options, at least buy puts and calls. you can start to get into this and start to see what goes on every day. It becomes something you're going to want to pay attention to if you want to get active, but there's absolutely money to be made here and so many decisions put on the table for you that you can learn how to make the right ones and have the algorithm assist you in that process. And you're going to make money. I keep making money no matter, I'm making a lot of mistakes and I'm still making money. That's a sign of a working strategy. So anyway, good luck. May all your trades be volatile and everything else be awesome. Happy June.